Joining us, Jefferies chief market strategist David Zervos. David, it's good to talk to you. What do you make of this move higher in yields?
Well, Sarah, I think it's a combination of a lot of things. One thing it's not is inflation expectations. It's really coming through the real rate side of the 10-year. The 10-year is made up of inflation and real rates, and we're really seeing real rates rise. I think it's a combination of maybe term premiums and real rates, but it's not about the sort of people getting nervous about inflation expectations over the long run,
Right.
the typical thing that people get excited about when we're steepening. So the question is, why are real rates up? And, I think that's going to be a hotly debated topic over the next, probably throughout the rest of the year and longer.
I brought up the term premium going positive for the first time in a while. And I do wonder, David, if there's some concerns about fiscal credibility, about the supply and demand of treasuries. What do you think?
I think there's that. I think what's happening in Japan with the end of yield curve control probably has a little bit of an impact because there's such a big global driver of long-term interest rates. And, Sarah, I think positioning might play a big role in this. If you look at the beginning of the year, most of the professional forecasting community for the economy predicted a recession now. And the interest rate market, if you looked at SOFR futures, we were forecasting rate cuts now. That was back in January. And obviously that hasn't been the outcome. And I think a lot of fixed income managers chose to take duration risk with that view as opposed to credit risk, which is the two ways that they can typically enhance a fixed income portfolio. And I think there's a lot of people who are underwater in that trade. I think a lot of people have been overweight the long end. And I think there's a bit of choking on that.
David,
I think that plays a pretty big role, yeah.
We got a pretty soft number in ISM manufacturing prices paid, and yet the yield picture today is what it is. Are you on the lookout for weaker activity failing to rein in yields?
I think it's early for weaker activity to do much of that. We had really good GDP revisions from last week that tell us this economy has actually been in a great place. The consumer is still in a great place. GDI is closer to GDP. The recession story is that much further off. And just a bad call by a lot of people in the market. I think we're going to get a little slowing, Carl. I think that's what you expect after 525 basis points. So the market's not going to be surprised by a little weakness, but the idea that we're going into something, a more sinister period for growth, I think is a really hard story to tell. And I think the yield market is reacting to other things related to what Sarah and I were just talking about, maybe real term premiums going up a little bit, real rate expectations going up a little bit, the Fed having to be higher for longer to keep the inflation trajectory in the right place.
Well, also quantitative tightening is happening, and the balance sheet is shrinking, and we got a big drop last week, and so that puts upside pressure on rates as well. David, what turns it around? What calms bond investors down?
Well, you're absolutely right, Sarah. The balance sheet actually, I think, broke below $8 trillion for the first time. We peaked at $9 trillion, so we've done $1 trillion of QT now, which is not a trivial amount. Remember, QE1 was $1.75 trillion, and that was considered to be a whole heck of a lot. So we just did, more than half of QE1 in reverse. So that's a big part of the story. And, Sarah, I've tried to work with clients all year and really thinking about what this balance sheet means, what the size of it has done to the economy, and having the residual amounts of QE in our system have meant. I think we all have to be pretty humble with the balance sheet and know that it's a new toy, it's a new policy, it has a lot of power to it, and we need to sort of step back and always take stock of the fact that it's something we don't know a lot about. So when someone sounds very confident, I usually look the other way. And I go back to that great Ben Bernanke quote when he was first asked about QE way back when it was sort of doing the trick, and he said, well, it works in practice, but not in theory. Works in practice, but not in theory.
Yeah.
And I think we all have to kind of abide by those words. But Sarah, you're absolutely right. I think that's playing a big role in the uncertainty, which in the end, it's the uncertainty about real rates, which drives the real rate risk premium, which I think is what's having an effect on 10-year yields. It might not just be expectations.